Good morning, everyone. Today, we will introduce our study on Hibiscus, Petroleum, and Bumi Armada, two energy companies in Malaysia. Our research looks at their financial performance, risks, and investment value from 2020 to 2023. We have studied their stock price, business risk, and market trends to understand how these companies perform in the industry. This is our content, and let's begin.
Hello, today I will introduce the company's background. We aim to examine the FTSE Bursa Malaysia KLCI market trends and access to energy companies, market performance, and investment value. Hibiscus, Petroleum, and Bumi Armada. Historical data from 2020 to 2023, including KLCI market data, corporate financial data, and industry analysis reports, were collected to observe stock price fluctuations, revenue growth, profitability, and market competitive dynamics. Second, company profiles. Hibiscus Petroleum engage in upstream oil and gas exploration and production in Malaysia and Southeast Asia as a leading independent producer. Its performance is closely linked to oil price and local policies. Bumi Armada offers floating production shortage and offloading vessels and offshore energy service globally. Its leader the FPSO market, operating in regions like West Africa, Southeast Asia, and India, with revenue from long-term contracts. We choose these firms for their coverage of different oil and gas value chain segments, upstream and midstream, providing a comprehensive view of Malaysia's energy industry. Both are liquid KLCI companies, suitable for trend analysis. Hibiscus offer growth prospects and risk exposure, while Bumi Armada provides suitable cash flow, giving multi-dimensional investment analysis input. That's the first part. Next, other members will explore standalone risk, portfolio risk, and more. Thank you.
After calculation, we get the standard deviation and the variance of the closing price. Bumi Armada standard deviation is 0.1984, variance is 0.0394. Hibiscus Petroleum standard deviation is 0.2219, variance is 0.0492. Hibiscus Petroleum exhibits higher standalone risk, indicated by a greater standard deviation and variance compared to Bumi Armada. This implies Hibiscus Petroleum stock price fluctuates more significantly, suggesting higher volatility and potentially greater risk and return opportunities. Bumi Armada, with its low variance and standard deviation, indicates comparatively less volatility. That is a comparatively more stable stock in terms of price variations.
Hello everyone, this part is about the portfolio risk analysis of these two stocks, Bumi and Hibiscus. The average return of Bumi is 0.012, the standard deviation is 0.195. The average return of Hibiscus is 0.019. The standard deviation of Hibiscus is 0.159. Additionally, we can also have the correlation between the two stocks, which is 0.578, and the covariance is 0.018. In the step 2, we can
use Excel volume to get the portfolio variance and the portfolio risk, just as shown in our slide. And at last, let's have a look at the different weightings of these two stocks. How can they affect the portfolio's risk and return? There are three scenarios. Number one, 25 hibiscus and 75 bumi. The portfolio risk is 0.173. The portfolio return of bumi is 0.009. The portfolio return of hibiscus is 0.005. The scenario number two, half of hibiscus and bumi. The portfolio risk is 0.158. The portfolio return of bumi is 0.006. The portfolio return of hibiscus is 0.01. In the last scenario, 75% of hibiscus and 25% of bumi. The portfolio risk is 0.153. The portfolio return of bumi is 0.003. The portfolio return of hibiscus is 0.014. So from these scenarios, we can get that as we increase the weight of hibiscus, the overall portfolio risk decreases. This is a clear demonstration of the benefits of diversification. While we increase the weight of hibiscus can reduce the risk, it also reduces the portfolio's return from bumi. This highlights the classic trade-off between risk and return in portfolio management. About the multiple weighting that depends on the risk appetite. The optimal weighting of these two stocks depends on the investor's risk tolerance, and we will discuss this in the next part.
Okay, we will explore the optimal portfolio weights of hibiscus petroleum 5,199 kl and Burmese Amada 5,210 kl. In investment decisions, it's crucial to balance returns and risks. We use the mean variance optimization, MVO method to balance returns and risks. We collect stock price and index data, calculate returns, and build covariance matrices. There are two key formulas to determine the weight. After calculation, the optimal weight for hibiscus petroleum is 40.97%, and for Burmese Amada is 59.03%. And we simulate portfolios by changing weights plus the efficient frontier and identify the optimal portfolio. In conclusion, the optimal portfolio efficiently balances returns and risks, maximizing the Sharpe ratio.
Today, I'm talking about two parts, beta efficient and investment advice. First, let's look at what is beta efficient. It measures the stock systematic risk use, KLCIS proxy. It's calculated by simple covariance and variance functions in Excel. And then let's look at the economy mean. If beta is lower than 1, that means high volatility and potential return than market. When beta is equal to 1, then means stock moves in syncing with market. If beta is smaller than 1, then means lower volatility and defensive nature. We use monthly closing price from January 28 to March 2022. Its return on computed from price change with outlier on the adjustment. Then let's talk about data aid to companies. The first company is Bumi Amanda. The market return ranged from 1.93 to 1.66. The stock price range is from 0.845 to 0.485 with high standing deviation, and the beta value is calculated as 1.85 with high risk. Another company is Hibiscus Petrol. The stock price range is 0.98 to 1.3 with lower standing deviation. Beta value of 1.32, so moderate market. The next part is analysis and investment. First, let's do the analysis of Bumi Amanda. Let's talk about habit drivers. It has an industry circle in oil and gas service. Also, the leverage in high in 2021. Then let's do the sensitivity checks. If we use population covariance, beta increases to 1.92. If we exclude early data, beta decreases to 1.82. That shows sensitivity on the data region and calculation method use the ZCMA, high expected return on lines. With high risk portfolio, last I have some investment recommendations. It's suitable for aggressive investor seeking high returns. It also requires monitoring of oil price at data levels. The last part is analysis is Hibiscus Petrol. If we look at the low beta factors, it shows really resilience during 22 oil price plunge. Also, it has lower correlation with KLCI, which means lower market sensitivity. Then move on to the ZCMA expected return. It's calculated as 10.9%. So moderate expected return on suitable for balanced portfolios. Therefore, I have some investment recommendation. It's good for medium to long-term allocation, but I may have potential place impacts.
Good evening, Dr. Roseland. My name is Duan Jie. Matrix number is 147407. Thank you. Today I'm going to talk about something very important in finance called the security market line, or SML for short. Imagine you are an investor looking to decide where you put your money. The SML helps us understand how different stocks or portfolios perform relative to the market. It's like a map that shows us which investment might give better returns based on the risk level. At the heart of the SML is the capital asset price model, CAPM. This model gives us a formula. Expected return equals risk-free rate plus beta multiply market returns minus risk-free rate. In simple terms, it tells us how much return we can expect from an investment given its risk compared to the overall market. Let's break this down. The risk-free rate is usually the yield on government bonds, which are considered safe. The beta measures how sensitive a stock is to market movement. A beta greater than 1 means the stock is more volatile to the market, while a beta less than 1 means less volatile. For example, if we look two companies, Bumi Armada and Hibiscus Petroleum, we find that Bumi Armada has a higher beta of 1.85, meaning it's more sensitive to the market changes. On the other hand, Hibiscus Petroleum has a lower beta of 1.32, indicating it's somewhat risk less. Now, let's plot on the graph. The x-axis represents the beta values and the y-axis shows the expected returns. The line starts the point where the beta is zero, with the slope equals to market risk premium, which is the difference between the expected market return and the risk-free rate. In theory, the SML is a straight line. However, in reality, various factors can cause deviations. For example, some stocks may outperform or underperform expectations due to the market inefficiencies and the company-specific events. Understand the SML helps investors make informed decisions. By knowing where a stock sits on the SML, you can gauge whether it offers enough returns to justify its risk. So next time you're thinking about investing, remember the SML is your guide to navigating the financial markets. Thank you.
Hibiscus Petroleum and Bumi Armada have different business performances and investment risks, leading to different investment choice. First, looking at the P ratio, Hibiscus reached a high of 17.0 in 2020, then dropped to 10.83, showing that market expectations had charged. But Bumi Armada hit 17.87 in 2019, but slowly fell to 9.7 in 2022, meaning investors had less confidence. This trend matches EPS changes, where Hibiscus saw a drop from 2018 to 2020, but made a strong comeback in 2021 and 2022, reaching 0.12, showing better profits. Bumi Armada's EPS fell to 0.02 in 2020, then slowly recovered to 0.05 in 2022, but at a slower pace. At the same time, dividend growth tells us more about their financial stability. Hibiscus cut its dividends by 50% in 2020, then had a big jump of 300% in 2021, followed by a 25% rise in 2022, showing large ups and downs. Bumi Armada's reduced dividends by 50% in 2019, but slowly recovered with a 50% increase in 2022, showing steadier performance. And looking at the market, Hibiscus as an oil exploration company is strongly affected by global oil price, which makes it a risky but a high reward choice for investors willing to take risks. And on the other hand, Bumi Armada, which depends on long-term contracts, has more stable cash flow but higher debt, making it a better choice for careful investors. Investment strategy-wise, Hibiscus is a good option for those looking for high returns when oil price rise, while Bumi Armada is better for stable investment, but investors should keep an eye on its diet and contract renewals. In the end, investors should spread their investments to lower risks and choose based on their comfort, risk, and market expectations.
From our research, we found that Hibiscus Petroleum and Bumi Armada have different strengths and risks. Hibiscus Petroleum, which explores and produces oil, has bigger price changes because it depends on oil price. This makes a good choice for investors who want higher returns but can handle more risks. And on the other hand, Bumi Amanda provides offshore oil service and has long-term contracts, making its income more stable. However, the company also has a lot of debt, which means higher financial risk. For investors, HBQ's petroleum offer higher growth potential, but oil price need to be watched closely. Bumi Amanda, with its steady income, is better for those who prefer lower risks, but they should be aware of its debt. A smart investment plan would include both stocks to balance risk and return. Look ahead. Future studies should focus on how environmental policies and market trends affect these companies. Investors should also keep an eye on the global economy and the oil price when making decisions. Our analysis presentation ends here. Thank you for your watching.